Getting leads is a big fear for many mortgage brokers, especially new mortgage brokers. And there are lots of ways you can generate leads. And that's what I'm going to unpack in today's video, because if you don't get them right, then yeah, it does risk the idea of never actually being successful in this career. But you can do it. And it's not a one size fits all. There's multiple different ways, multiple different routes. I'm going to unpack them in this deep dive video today. If you've got any questions, leave them in the comments. I'll be more than happy to answer them. And let's dive straight into all of the ways that mortgage brokers get leads. So the very first way we talk about this that everybody kind of knows about is estate agency partnerships. Okay, estate agent partnerships are probably going to be the number one way that most people, especially when they're starting off, think about this idea of how they generate leads. So let's talk about how they work, what they do, and the pros and cons to them. So the estate agent is going to get the lead. They're going to pass it to you as the broker. So that's the broker. That's the EA. They're going to pass the lead over, and for passing that lead over, they're going to want a percentage of commission, okay? That's normally what's going to happen. So the estate agents will get the lead, they'll pass it to the broker, and they'll normally want a percentage of that commission. Now, the commission can be broken up into a number of different ways. It's normally going to be anywhere from about 10 to 25% of the actual full case. It might include fees, so it can include fees, but doesn't always include fees. And rarely, not often, but it can happen, it can include the protection as well, okay, which you ideally want to avoid if that is the case, because that's where all the money is made. But the percentage is there. Now, that's kind of how that works. So the lead comes in through the estate agents, they provide the lead to you, you contact the lead, you convert it, and then you give them anywhere from 10 to 25% of the agreed upon amount. So the pros for this, of course, is going to be that there's lots of people. So there's lots of people who are going to buy houses. I mean, you literally are going to the place where they're going to be, because people who need mortgages, they need mortgages and they're buying houses. And if a estate agent is buying a house, what you get here is you get really great, what we call demand leads. So there's lots of people and you get demand leads. Now, demand leads are people who are needing a mortgage right now. So they need you. They don't know you, but they do need you. And so they've got high intent. So they really need that mortgage now, which means there would be what we sometimes call like hot leads. So the leads that really need help right now. So that's the pros to that too. The other pros as well is obviously that you're going to get more exposure to local market. You're more, ideally with the estate agents, you're going to have that local market. So that's the pros, but it is not all pros at all when it comes to estate agents, because there's a lot of cons. So let's talk about the cons. The big con being that it might be high demand, but it's low trust. So straight away, this high demand but low trust is this issue, meaning I have a mortgage, I have a property I want to buy, I need a mortgage right now, I've never heard of you before, and the estate agent, who usually have the most trust in the whole transaction at the best of times, they don't really, they vouch for you, but I don't really know you. It can be very difficult. So that's going to be the con. Big con, in my opinion, is the low trust. The other big con is that most estate agents are rubbish. All right. So most EAs are rubbish. I think that's very rubbish with my dyslexia, especially when it comes to passing over leads. They have very little interest or very little respect when it comes to mortgage brokers, especially in the culture. If you look at these large companies like Connells, like Countrywide, like Just Mortgages, the culture on there is very much a them and us situation. So estate agents have very little respect, very little time for mortgage brokers, and they get really annoyed by them a lot of the time. They also don't understand what you do. So they don't understand. So they don't understand what it is you actually do. And so because of that, they don't understand your situation. They will chuck stuff over to you all the time. You're in a regulated environment. It can be a real problem. Also, the money isn't great. So the money is actually not great at all, because by the time you've split away and paid away, it's not that awesome. And especially with the type of leads that come through, the protection opportunities and the stuff that I do within my mortgage business mastery blueprint, the whole framework that we use of like the customer journey and the kind of staffing and then the enhancing of the evolution of the offers that we do, you can't actually do that, because they're just like, I just need a mortgage, get it sorted for me. So it's not the best situation to be in. So, but that's one of the ways. So that's the kind of one way of generating leads. Let's look at the next one. So the next one we have is introducer relationships. So introducer relationships, effectively estate agents are introducer relationships, but this is just giving a more broad stance on it. So introducer relationships are going to include, outside of estate agents, because they have their own kind of way of doing it, you're going to be looking at accountants, you're going to be looking at IFAs. That normally, to be honest with you, is the main kind of two. So the pros for having, say, IFA and accountants is there's going to be more trust. Okay, so there's going to be more trust because you've come from a more trustworthy source. You're going to probably have bigger cases. So it could be bigger cases. You might actually make more money because a lot of times they don't want commission, which is quite interesting. A lot of times these type of people, they make their money in other ways. They want to refer to somebody that they know is going to look after their client. So they're less interested in commissions. And even if they are interested in commissions, they're not interested in scalping you for like 25% of your commission. They might just take a flat fee of say £100 per case and they're fine with it. They don't mind at all because these people are making their money doing their professional job, which is their recurring revenue coming from everything they do. So they're not, it's a different type of scene, which is really, really good. And it can be quite niche. So the pro for it as well is it can make it quite niche. So the niche there is usually going to be self-employed is what you end up going into when you actually do it that way. Self-employment becomes the niche that kind of gets defined within this. So it's quite good. And that's definitely the pros. But there aren't all pros, as there is with any of them. There's going to be some cons as well. So let's look at the cons for a second. So with cons, what we actually have is, the first one is not much. As in, there's not much going to come your way. You're not going to get like a boatload of leads. It doesn't really happen that way. It's not just an army of leads coming in. It really doesn't. It is the odd one or two. So unlike estate agents that are just going to have constant flow of like revolving door of people constantly buying houses, accountants and IFAs and introducers like that, they're going to have the odd one or two. And you might end up getting one a month if you're lucky, maybe two a month. So there's not that much going through. They can be hard to motivate. The actual introducers themselves can be pretty difficult to motivate. And the reason why is because they're very successful financially in their own right. So it goes back to the whole thing of they don't really want the commission. They also can be like, well, I'll get around to it. If someone asks me, I'll tell them, but I'm not going to like jeopardize my own relationship with my client to recommend you. And that can be a problem because you're not going to get loads of business from it. They're just usually going to come up when they need it or they decide it's the right thing for them. So that can be a real con as well. The other one as well is they are hard to find. So they're hard to find. They're not easy to find, they're not easy to get hold of, and they're very hard to get in front of because a lot of the times they don't want to speak to you. And if they've got somebody already, why would they bother speaking to you? So these are the cons with that. So that's that next set. So we've done estate agents, we've done introducers. Let's move on to the third one. So the third one we have is referrals. Now referrals is where people are referring into you from friends, family members, existing clients. So referrals are exactly this. If you think about the way that the way to look at referrals is, and I like to look at it like this, is let's say that this is a client and they refer two people and then they refer two people, kind of a pyramid, as you can see we're going. So they refer two people, and you can see this can just grow indefinitely all the way to the end. This is a referral. Now referral is not introducers, it's not estate agents. They use the word referral, but that's not what I class referral as. A referral is something you're not paying for a referral. You're not giving anything away for a referral. Referrals come from people who are actually referring people who has already worked with you. So they've worked with you, they love what you're doing, and then they're speaking about you like brand ambassadors in some ways, but they're proud that they've worked with you, they like what you're doing, and referral is great. Let's talk about the pros then to referrals. So the pros is obviously 100% yours. So the 100% yours, you're going to get all the commission because they're referring off their own back. The other one as well, which is really good with this, is it's going to be high trust, very high trust, because the people who are contacting you and they're getting in touch with you, that's because they've been referred from somebody else who's already spoken about you and spoken for you and vouched for you. So it's really, really, really good. You can also get what we call a niche compound. And what I mean by that is the same type of people refer the same type of people. So you start to really cement yourself and compound within your niche. So if you're working with, say, like a self-employed people, and then you're constantly working with self-employed people, more self-employed people will recommend other self-employed people, and it just kind of becomes a perpetual cycle. These are great. And they are, in my opinion, honestly, they actually are the best leads by far. They're the best leads. But they're not all sunshines and rainbows because there is cons to them too. So let's talk about the cons. Realistically, there's only one con in my opinion, and that is they take a long time, okay? They take ages to build. This is the main con, is they take a long, long time to build. So it requires years. Most of the time, it's like up to a decade of constantly compounding in your business to get to the point where people actually are referring you and that they become a real true lead source. And you do see this at some mortgage brokers who I work with and they've been in it for a long time. They're like, I get all my business from referrals. And then how long have you been in the business for? And it's like, oh, I've been in the business for 15 years. Like, yeah, what a shock. You do also, though, see people who are like, I get all my business from referrals. How long have you been in the business for? Oh, 2 years. It's like, no, you're getting it from demand. You're getting it from like other like introducers referring it in. That's not a referral. That's an introducer agreement. Very different in the way that we define them here. So they're not the same thing. But referrals, by far the best type of clients you get, how you can get them is by referrals. The next one you have is social media. Now, social media is interestingly the one that I did when I first started out, and it's actually how I built my career. I got known as being the mortgage broker who was on social media, and then the mortgage broker, the coach who trained brokers how to use social media, and then moved obviously into becoming a broker and business coach for the industry, which is where my true passion is. Now, social media is a really interesting one because social media works in a very a great way, but there's a way in which you make it work. How you do with social media is you have to have the following 3 things. You need, let's do that. So you need awareness, you need nurture, you need action. So you need action. And that is the structure of a social media, the way that social media clients come in. So what this means is awareness is the client didn't know you. So they don't know you. They've never heard of you. And now they've been made aware of you. That's how social media works. So they come in, they've never heard of you before. They found you on search. They found you on, some form of like, they found you, videos landed on their feed, whatever it may be. They're now made aware of you. What then happens is these people might be what we call a passive prospect. And that means that they're not in the market for a mortgage right now. So they don't actually need a mortgage, but they're now aware of you. So that's when we move to nurture, okay? And nurture, they're still going to be a passive prospect, but the idea of nurture is that they go and they see you normally about 8 to 10 times before they like know that what you do. So it normally takes about 8 to 10 times before they know what you do, and that's what we call nurture. So if you think someone's been made aware of you, it's that know, like, and trust. They've been made aware of you, and now they have to like and trust you in what you do and associate you as a mortgage advisor. And that's going to be a long time. And so you're building that relationship with these people through time online, and then it builds awareness of what you do and nurture them through that. What then happens then is when they become what we call active prospects, which is literally they have they're ready to buy a house, they're ready for a remortgage, whatever it may be, they're now active, and then all you have to do is have an action part in your content. Action is it really clear where they go to take action? There's normally going to be an optimized social media profile. It's going to be an optimized website, however it may be, but it's getting them off the channel. So if you think about it this way, the social media account is where you go and find new people. It's where you nurture them and grow them, and like planting a seed, you're growing it, and then you take them off the platform with action and then into your sales system. But it's normally, the idea is literally just taking a passive prospect and making them active. Being around, more importantly, when they're active. You can't make them active. It's being visible and around until they are active. That is the goal of social media. That's how you get clients through social media. But it is not all sunshines and rainbows. So let's unpack the pros and the cons of this one. So the pros to this one is going to be straightforward, which is it's free. All right, it's free. Easy, it's free. Doesn't cost you anything apart from obviously if you want to like coaching or anything like that, but really you don't have to pay for marketing or advertising or anything like that. So it's great. The other then con you have, the pro you have, is that it's fully yours. It's yours 100%, and you're building something. So it's 100% yours, and it's building a brand. So it builds this brand that means that you stand for something that's pretty clear, and you will make a lot of money, by the way, if you've done it right, because these people will have been nurtured by you. They would have been made aware of you. They've been around for potentially 2 years. So you become their mortgage advisor. So when you're actually going to sell the protections and insurance and things like that, these guys will buy anything because they have been pre-framed to work with you. So they're great. That's the pros of it. And they're phenomenal clients, but they're definitely not without their cons. So let's talk about cons. Cons is it takes a long time. Again, just like the referral system, it's the same thing. It's building, it's slow, it's forever. It takes so long. So it's quite common for it to take a long time, and people get really burnt out about it and they're like, oh, it's not for me. And then they give up. And sadly, that's where most people fail with it. But actually, if you continue through and push through, you can have a phenomenally good situation, but it does take a long time. That is the con. And to be honest with you, though, it's also, the other one is it's hard to get right because there's a lot of noise out there, from marketers and people that are going to constantly derail you from the strategy. So if you think that the goal, if we're trying to build this system, but every time something like TikTok or something like, oh, look, we need to change our strategy, every time you're deviating away, you've got to start building like new strategies, new systems. It's very, very easy to get distracted and move to something else. And that's the bit that we need to really be careful of with social media. But the cons really are, it takes a long time, like way longer than people realize, but it's brilliant. And so the best way with social media, if you want leads from that way, is you need to start it like right now. Start now for the next 2 years. So average, it's going to take about 18 months to 2 years to get the thing rolling. And it would make sense because if you look at it from 18 months to 2 years, if we think that our goal is for a passive prospect, well, they're going to be 2-year fixed deals. If they become active, if you start marketing now, they've got at least 18 months before they can do anything. So your content, your marketing, for enough people to see it, it's about 2 years because it takes about 18 months, 2 years before people are going to start falling off of those deals and become activated, or they've actually saved up for a property, for a deposit and they want to move. That's where that comes in. It's not just that social media takes a long time to build brand. It's that it takes a long time for the clients and the nature we're in to activate. So that's another way you can get leads. The next one to talk about is repeat clients. So repeat clients is sometimes referred to as your back book or your client bank. This is just really straightforward. Effectively, Mr. or Mrs. Client, they do a mortgage with you, and then 2 years goes by, and now they need to be remortgaged. And so they're going to come back. So 2 years, and then it's a remo. And so they'll come back. And if you do more of these, the more of these you do, it's going to multiply every time, again and again and again. If, though, by the way, you do all those other things as well. So if you have really good social media in place, it's going to keep them coming back because you're going to re-engage them. But also repeat business is just another way of doing it. And it's what a lot of people talk about in this. Pros is you're going to have more income stability, okay? So you're going to have more income, you're going to have some more stable income. The other pros of this, though, is they trust you massively because they've already worked with you. So they trust you again. They're already pre-sold on what you do. So these are all of the pros to it. But there are cons. And I think that the cons are, with a lot of this, is, and very much so, the biggest con here is that they don't come back. So the biggest one is they don't come back. And why I say that is, that if they don't come back, if you don't market to them and re-engage them and reactivate them, they aren't going to come back to the bank. They'll go to the bank, they'll go to another advisor, and that is a common mistake. So what people often think is get this client back and you'll be set. That's not the case. You need to nurture them. You need to have what we call relationship maintenance and reactivation. We do that within my MBM system. So that's what you have to do. The other thing as well is they can actually be low value. Okay, so low value, because if you've done the job right and you've done good insurances and everything like that, the income can be quite significantly less on them. So it's something to be aware of with that. Those are the only real two cons about those, is they are hard to come back, or they don't come back if you don't have a right system in place, and they can be low value. But they are really, really good, and they are a cornerstone of how you get clients. Which brings us on to the next one, which is online marketing. Now, online marketing is going to be a number of things. What we're talking about here is really SEO and ads, okay? They're kind of the two main things that online marketing is going to be. So SEO and ads. What does SEO mean? SEO means search engine optimization. It's effectively optimizing your business, your brand to appear in search. So wherever it's found, it's going to be found online, and people search something and they find it. Now you can do this in multiple ways. You've got ChatGPT, you've got Google, you've got YouTube, you've got social media. Search engine optimization is massive. And so that's a great way of getting good leads. The other one you have then is ads. Running ads on things like Facebook, Instagram, LinkedIn, Google, YouTube, whatever. Running ads to get in front of people who don't know you. So that's online marketing. So let's talk about the pros and cons to it. Again, the pros to SEO is going to be that it's organic. So it's going to be free, which is amazing. The other one is that it's actually going to be They're great leads because they are demand leads. If they are searching it, they have high intent. And then you're being served up as the authority, which means their trust might not be very as high as, say, they saw you on a brand, but it's much higher than an estate agent saying you should speak to my mortgage advisor. So it's still pretty high trust. So that's really, really good. And if done well, they can be nurtured into a lead magnet, which is effectively a system that if they're not quite ready, they can be put into an email marketing system that allows them to continue to be marketed to. So that they are really good leads, and it's probably one of the most underutilized and most compounding ways of doing it. And the best way to do it, by the way, is just get good Google reviews. Good Google reviews and then content strategically placed on high search term traffics is going to do well. The cons, though, to SEO are as follows. The big cons is it's very competitive. There's lots of people who are absolutely trying to rank for these, and so it's very, very difficult to do. The other one is it takes a long time. So it takes ages. It really takes like months and months, if not years, to start to rank and get leads. And it's hard because there's so much misinformation out there now about what you should and shouldn't be doing that it becomes really, really difficult to get right. So that's the cons to SEO. Let's talk about the pros then to ads, because ads is the other side of marketing. So the pros to ads are as follows. The one is it's direct targeting. So it's direct. You're targeting somebody exactly straight to them. They have this problem and you're going to go and serve them, which is really, really good. Now, to be honest, outside of that, it's literally the only one because there's a lot of cons. And if we talk about the cons on this one, there's a lot. First one is it's very expensive. It's very expensive. It's very hard to do. It can yield really bad results because the clients oftentimes, if an ad's just dropped onto their feed and they need help, you're going to get them. And they're like, I don't really know you, don't need you. There's no trust. There's nothing at all. And it can be incredibly expensive. As I said, there's a lot of cons when it comes to ads. We're kind of circling around this marketing one here for you, but that's kind of the big one. So then there is one that we haven't spoke about, and I want to address that one here in this video here before we end it up, is buying leads. So buying leads is something I just recommend you shouldn't do. The reason why is everybody goes to buy leads because they think it's a good idea, but it's incredibly expensive and incredibly time consuming with very little yield. It also doesn't allow you to build any true lead generation in your business. It's relying on something like a crutch to continue to feed to make money. And that's okay at the beginning if you need to do it, but realistically, you're not building anything. And if you're somebody who's just buying leads and you're self-employed, my advice to you would be go employed, or stop spending that money and go and figure out how to start generating leads organically where you are paying for them either through through introducers. Any of the methods I've used out here, they're all good, they're all fine. Find ways to do it that way as opposed to just buying leads on something like Unbiased, where you are literally just paying for somebody who's done all of these things above, but that client has no idea who you are and they've shopped that lead to everybody else. That's the big mistake people make. Now, I'll tell you what, if you're interested in how you can grow your mortgage business properly with all of the frameworks and all of the systems of where this can really go to once you've got those leads and how you do it effectively, I would recommend you check out this playlist that I've got on screen now, which is my mortgage business blueprint. It's effectively the framework you can follow in order to grow and where your business can actually go to. I'd recommend you check that out. Give it a click.